Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's topic with you. We're seeing a significant shift in the market, folks. Foreign institutional investors, or FIIs, have reversed their selling trend and are now buying into Indian equity. In April alone, they purchased equity worth Rs 3,243 crore, marking a notable change in strategy. But what's behind this sudden pivot? According to experts, two key factors have contributed to this reversal. First, President Trump's announcement of a 90-day pause in reciprocal tariffs led to a recovery in global equity markets, with India outperforming the pack. Second, the weakening of the US dollar has facilitated FII inflows into emerging markets, particularly India. Now, it's essential to consider the context here. FIIs had been consistent sellers through the exchanges during the first quarter of calendar year 2025, cumulatively selling equities worth Rs 1.2968 crore. But in the last 12 trading days, they've bought equities for a whopping Rs 40,145 crores. That's a significant turnaround, and it's crucial to understand what this means for the market. While FII inflows can remain stable, they're likely to be constrained by modest earnings growth of around 5% in FY25. So, what does this mean for investors? Should you be optimistic about the market's prospects, or is this just a temporary blip? We'll be exploring these questions and more in today's episode. We'll delve into the implications of FII inflows on the Indian stock market and discuss what this means for your investment portfolio. So, stay tuned, folks. We've got an exciting discussion ahead, and we'll help you navigate the complexities of the market. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show today, and I'm excited to dive into our middle segment. If you've been following the world of finance, you might have noticed some interesting trends emerging in the market. Today, we're going to take a closer look at what's happening with gold prices and how it might impact your investments. According to Quant Mutual Fund, gold has exhibited tremendous potential, but they're expecting a correction in the near term. This is based on historical data, which shows that May is generally a profit-booking zone for gold. The fund house believes that after sharp corrections in the US, a pullback rally is likely, and global equity flows towards the US have peaked out. Now, this might sound like a mixed bag, but it's essential to consider the bigger picture. Quant Mutual Fund remains constructive on precious metals in the medium and long term, suggesting that a meaningful percentage of your portfolio should be dedicated to them. It's also worth noting that the global liquidity metrics have started deteriorating, which could lead to a risk-off phase for U.S. equity. On the other hand, India seems to be endorsing a risk-on phase, both on absolute and relative basis. In terms of currencies, the DXY index has corrected quite meaningfully since January highs, but it seems to be bottoming out at current levels. A pullback rally is possible, especially with May being a seasonally bullish month for DXY. Lastly, let's touch on crude oil and Bitcoin. The downside seems to be exhausted in NYMEX crude, and May is also a seasonally bullish month. As for Bitcoin, although the month of May is generally flat to bearish, Quant Mutual Fund's analytical tools are endorsing a bullish outlook given the current global uncertainties. It's crucial to keep in mind that these predictions are based on data analysis and should not be taken as investment advice. It's always important to do your own research, consider your risk tolerance, and consult with a financial expert before making any decisions. That's all for this segment of the Riskwiser Zone. Remember to stay informed, stay vigilant, and always prioritize your financial well-being. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone, Today, we're going to dive into a fascinating story about investment strategies and market trends. Our topic for discussion is a letter from Alex Umansky, portfolio manager at Baron Capital, where he shares his insights on the current state of the market and the companies they're invested in. It's interesting to note that Umansky emphasizes the importance of taking a long-term approach to growth investing, despite the uncertainties and challenges in the market. He mentions that history suggests most of these challenges will prove passing or manageable, and it's essential to focus on the intrinsic value of the companies rather than short-term fluctuation. One key point that caught my attention was the discussion about growth stocks and their potential risks. Umansky highlights that investments may involve additional risks, including exchange rate fluctuations, political or economic instability, and limited disclosure. However, he also emphasizes the importance of doing thorough research and due diligence to mitigate these risks. The letter also provides an update on the portfolio holdings in the companies they're invested in. It's clear that the team at Baron Capital is optimistic about the long-term prospects of these companies, but they're also cautious and patient in their approach. As we wrap up today's discussion, it's essential to remember that investing always involves some level of risk. It's crucial to do your own research, set clear goals, and diversify your portfolio to minimize potential losses. That being said, the letter from Alex Umansky provides valuable insights into the world of growth, investing, and the importance of taking a long-term approach. Whether you're a seasoned investor or just starting out, it's always essential to stay informed and adapt to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.